Okay, just finally, I just was hoping to ask you a little bit about the issue of money creation. Now,
here's some.
We get a lot of comments on our site about this, and you're probably familiar with the papers that came out of the Bank of England 3 or 4 years back. I'll just read you a little bit from this. So one of the things they said is when a bank makes a loan, for example, to someone taking out a mortgage to buy a house, it does not typically do so by giving them thousands of pounds worth of banknotes. Instead, it credits their bank account with a bank deposit of the size of the mortgage. At that moment, new money is created. Now, this has created a perception that banks can create money out of thin air and they don't really necessarily need to borrow through deposits or bonds from the public as they do. These two things seem to be at a bit of conflict. So I'm just curious as to what's the take from you?
They can create credit, and that credit has to be good credit because they need to get it back to pay the people who they borrowed from. And that's why we need more capital. So we are the only ones who have the monopoly right to create money per se, which is, the notes and coins. And that is why we then set and make sure that our money remains worth something. That's why we keep it a low and stable inflation. And we make sure it's very hard to counterfeit so that people trust it and can put it in their pocket and a means of exchange. The banks need to borrow. They can either take it from shareholder capital or they can raise their own debt so that they can then on-lend. But banks can lend more than they borrow because they can have leverage, and that really comes down to about how much more capital do they have. But it all has to sheet back home to our interest rate and our amount of money, and if we see inflation running out of control, we always have the total ability to maintain that. So there's core money, and then there's the wider credit that's available in the world.
Is this an area that you've talked about much internally at the Reserve Bank, that in terms of the public understanding of how this works?
We obviously need to get better, judging by some of the comments that you've been talking about. And yes, we have, and we've got some publications, and so we will blow the dust off that and put it back out so that people understand what core money is, and then what the role of credit creation is, and how banks create that credit. And it's really critical, in particular, for the capital part of it, because if you only have to hold 10 cents for every dollar you loan, then if everyone comes back at the same time, if all the people that borrowed the money, lent the money to you, to the bank, comes back and says, I want it back now, well, you haven't got it. You've only got 10 cents in the dollar. And so they have to be comfortable that they have lent appropriately.
Well, look, thanks a lot for that, Adrian. That's Adrian Orr, Reserve Bank Governor, and I'm Gareth Vaughan at interest.co.nz.
Mitigate the risks. So when I think about it, the similarities, so what you're talking about is quantitative easing, which is what we're doing now, government determines spending and we determine monetary policy, inflation. You could shift to, at an extreme, something called money financing, where the government says, I want to spend 100, Adrian, credit our account with 100. And that's just us, creating money.
And if they asked you that?
Well, currently I wouldn't be able to do it. It would be outside of our legislation, and they would have to be going through a very transparent policy and process to achieve that. Now, the answer is you could achieve that, but you would have to achieve it with eyes wide open around what.
So will the RBNZ contemplate direct monetisation of New Zealand government debt?
I think we have to remain open-minded. I wouldn't rule anything off the table because it's, again, about being prepared, not predicting. The direct monetisation, I know it's been heresy, taboo for a long time, but really it's only a long time in our lifetime. It's not a mysterious issue. It's just not how we've run business. With it comes as many risks as opportunities because, blurring that monetary and fiscal policy together can lead to very relaxed fiscal policy where money's spent, where it's just not most effective. Likewise, it can lead to high inflation if there isn't that operational independence to tighten when you need to tighten, i.e. when the economy's back on its feet. So again, there's no free lunch, but you shouldn't rule any option out.
For bread. So that is critical. A central bank digital currency, meanwhile, is simply an electronic signal that sits in the central bank that says, I owe you something. So it's no different to an electric signal that sits in a retail bank. Except this time it's with the central bank, and because it's with the central bank, it's narrow money. It is the true fiat currency rather than broader money created by the retail banks themselves, through fractional banking. So it's the equivalent of having a physical $1, a physical note. You've got an electronic signal with the same insider high-powered one-to-one relationship. We all know this, and I don't want to create a sudden rush for the door if you're just realising it, that if we all went to try and take all of our deposits out right now, the banks wouldn't have it. They lend out far more than they physically hold, and that's fractional banking.
Simply flooded the system with money.
Yes, we did. That's another way to think about it. We did.
Where does it come from? Do you just print it?
We print it digitally. So we as a central bank, we have the ability to create money digitally, and we do that by buying treasury bills or bonds or other government guaranteed securities, and that actually increases the money supply. We also print actual currency, and we distribute that through the Federal Reserve banks.
New Zealand is a robust economy, and we can service debt somewhat higher than where we've had it. One of the reasons we've kept it low is because we have tended to be susceptible to the impacts of global economic shocks and also natural disasters, which we've been unfortunate to have several of in New Zealand. So, as we say here in New Zealand, this is, we do this so we're ready for a rainy day, and it's pouring outside, and so we are now in a position to be able to use that debt position. We'll continue to be careful with our spending, but as most countries around the world have done, we've put in substantial support packages already, and there will be more to come.
We've crunched the numbers here at Bloomberg, and by our calculations, the RBNZ is on track to owning almost 30% of New Zealand's debt by February next year. I'm wondering whether debt monetisation is really an inevitability at this stage. It's taboo. The governor seems to be open at least to talking about it. But what are your positions on that? And I guess what are your assumptions as to what that means for government spending, what it means for inflation, Kiwi asset prices?
Yeah, look, I think, at the moment the bond markets are continuing to function and operate well in New Zealand, and clearly the Reserve Bank is involved in the secondary market, and that is continuing to operate. Liquidity levels are good within our banking sector, and so for now the approach that we're taking, I believe, is correct and right. Obviously, around the world, we're seeing the more direct involvement of central banks in bond purchasing, and that's obviously suitable for those countries at that particular time. What's absolutely clear is what everybody used to call unconventional monetary policy is now front and centre of the monetary policy of most countries, and so therefore it's a dangerous game to never say never on approaches. But
inflation is a worldwide problem at the moment.
What a load of rubbish. That is a load of rubbish expounded by Chris Hipkins, Jacinda Ardern and Grant Roberts.
We must open ourselves up to a greater extent of foreign direct investment. Right now we're one of the hardest places in the world to actually send money to as a business. Our Overseas Investment Office ensures and sees to it that it's difficult to invest here. We need more openness. We need a regulatory environment and a tax environment that mean if you invest in New Zealand, you don't fear that you will lose more of what you've put in to higher taxes or regulatory capture that mean you can't get a return on your investment.
Third, we will turbocharge the innovation engine, backing firms to embrace productivity-enhancing technology, easing access to global capital that will allow new ventures to expand and flourish, and remaining open to the talent and skills immigrants can bring. Fourth, we will stop the tidal wave of mostly well-meaning but ultimately destructive regulation that has come to smother too many business owners. From the triple CFA, which has strangled access to credit, particularly for low income and low wealth individuals.
Deep contraction on the second quarter.
You have launched quantitative easing in Indonesia earlier this year in response to the coronavirus. Are you concerned about whether that could be problematic in the longer term?
When they saw the declining very sharply aggregate demand, Bank Indonesia supported by lowering interest rate, lowering reserve requirement, so that they are increasing liquidity in the economy. But that's not going to be adequate. So that's why between Government of Indonesia, Minister of Finance, and Central Bank, we agreed to have two mechanisms. First, Bank Indonesia allowing to buy the government bonds directly on a primary market. This is unprecedented. And the second one, even for what we call it a real spending, which is affected by this COVID and directly benefiting people, for example, like health, social safety net. We agreed with Bank Indonesia that for this kind of spending, we allowed to get direct placement of government bonds by the central bank. So in this case, it's not even through the primary market. They are directly buying the government bonds, and with even special interest rate. For the health, social spending, we are allowing to have a zero interest rate coming from Bank Indonesia.
Are you concerned that this very loose monetary policy will damage Indonesia's credit rating, will limit your ability to tap global credit markets over the sort of medium term?
Well, this extraordinary situation, we're really handling, of course, with an extraordinary way, but we're also very careful and very mindful about the reputation of Indonesia, especially our hard-earned reputation of a sound and prudent macro policy. So when we are adopting this extraordinary measure, we communicating directly with all rating agency and bondholders.
I wanted to talk and ask you about Bank Indonesia because there are some analysts, some observers who are concerned about the political influence over the central bank.
Although we are facing extraordinary time, we also see that the independence of the central bank and the soundness of the macroeconomic policy, that is the mix between prudent fiscal and monetary policy, is the necessary condition for us not to just recover at this moment, but also for us to sustain our recovery and continue growing.
Minister Shrimaleni, of course, we have to take a look at oil surging as much as $139 a barrel. Some say 185, 200 may be coming. If local fuel prices are not raised, Pertamina is expected to book losses of as much as $500 million. Do you think there's a need to raise prices? And if so, how big an increase are you looking at?
Well, first, we have to really look at not only one commodity. As I said earlier, within the context of navigating and managing this recovery process, we will use all tools as well as source of uncertainty that potentially threatening the recovery process. Fuel, electricity definitely will have the implication due to the oil, gas increase, even coal price, which is creating a cost pressure on the cost of the electricity as well as fuel in Indonesia. We have calculating, of course, with some scenario, if you are not going to be able to pass through all those pressure to the consumer, what does it mean in terms of the subsidy or compensation that we have to pay for the Pertamina as well as even PLN? And that's definitely will contribute to the increasing spending. But as I said, the third year of the pandemic, actually this year, we still have around 450 trillion of what we call it recovery fund. And we are going to use this recovery fund first, of course, to still continue supporting on the health spending, which is still very important. We want to achieve 70% of vaccination and even providing booster so that the pandemic or the COVID is not going to create uncertainty on this recovery process. Second one, we provide social protection, additional cushion because of the increasing price of commodity that will then affecting the purchasing power, especially for the vulnerable household, just like my colleague, Minister Domingos mentioned. We are providing additional cushion on social spending. The third one is, of course, we are going to then decide what administered price that can be then adjusted with this kind of changing global environment. will be very selective, will be very measured, will be also in this case looking at our own strength of the recovery, but also at the same time, we have to be committed to the consolidation of our fiscal. So the combination of the commitment to reduce the deficit below 3% next year on the one hand, and on the other hand, we are going to make sure that the recovery will be actually built on a strong foundation and the ability to cushion the shock, which is mainly coming from the external. Right. These three combinations that we are now managing, and I think so far until this March, our ability to do those triple objective is relatively on track. So we will have the ability in terms of managing our fiscal pressure, providing support in terms of both subsidy, direct or indirect through the commodity, and at the same time also making sure that the recovery is going to be in a firm ground.
We've been talking about Ukraine and the sanctions on Russia. What do you make of the consequences of US sanctions on Russia's central bank, which effectively cancels its reserves? Would that encourage you to diversify your own reserves, Secretary Dominguez?
Well, you know, we're very concerned about sanctions, because they eventually will affect us. We are not directly affected, but, it's like a ricocheting bullet. Sometimes we get hit. On the sanctions on the central bank of Russia, we actually will have no effect on us since our trade relations with Russia are quite limited, and same with the Ukraine. But this will certainly affect world trade, continue the disruption that was started during the pandemic of logistics and the ease of doing business, particularly in Europe. We are concerned that there might be a effect on the vigorousness of the economies in Western Europe and the United States, who are our big trading partners. So, we are concerned. We are not directly affected by these sanctions, but we are quite concerned on the effects on the overall world economy.
Minister Srimulyani, might you do more business in other currencies, say the yuan? There's been greater demand for the Chinese currency.
Well, first, I think what is happening in Ukraine definitely creating a new sense for all policymakers in the world, whether we are going to face a totally new world order. Globalization has definitely become one of the most important victims of this conflict, because then people don't trust the global supply chains with some uncertainty coming, whether from the military operation or other sanction which can be imposed. And that is one of the most important setback for the global economy. As we are witnessing in the past 3 or even 4 decades, many countries, especially emerging and developing countries, they were able to reduce poverty, to increase prosperity, because they are linked to the global economy through trade, through investment. With this conflict, when then there is uncertainty regarding the security of this system, definitely will affect the change as well as the implication on the strategy for growth in each country. As of, I think, the ability to diversify of the currency in Indonesia since 97-98, after the financial crisis in Asia, including Indonesia, as well as the global financial crisis, we also, in this case, within ASEAN, we've already, Bank Indonesia and some central bank in ASEAN has already also initiated using the local currency for our trade relation. That's also including with the China. But if you look at the percentage, it's still relatively insignificant. So whether this global order will be changed radically and permanently, this is really something that need to be watched. And of course, within the context, for example, like G20 and economic cooperation, we do want the world to come back to the cooperation spirit, because only through this kind of cooperation that all countries will have the opportunity to improve and increase the prosperity of their people and also to achieve progress in their economy. So we do hope that this kind of situation can be restored.
I'd like to touch on your fundraising plans. Secretary Dominguez, any update on plans to sell at least $500 million of ESG bonds? Will you push through with it?
Well, we are evaluating the market at the moment. As you know, the market is very volatile, and we are taking a very, very close look at the issuance of our green bonds, which is in the pipeline. We have not yet made a final decision on that, but we are going to be ready as soon as the market conditions, how would you say, improve or stabilize.
What are the offshore bond markets will the government consider tapping in the first half, or at least before you step down as finance secretary?
I beg your pardon again?
What other offshore bond markets will you consider tapping before you step down as finance secretary?
Definitely we're looking at the samurai market. But basically, we rely on our domestic market to the extent of 70 or 72% of our bond financing. The foreign financing is just less than 30% of our total package. And in the meantime, we have been really developing our local capital markets together with the support of the monetary policies in reducing the reserve requirements of our banks here. So again, we look at both markets, but depend more on our domestic peso bond markets.
It is a risk-off sentiment. Minister Srimulyani, are you concerned about the appetite for Indonesian bonds?
Well, so far, of course, Indonesia enjoyed, as I said, 2021 end of the fiscal year was actually in a very good result. And we have what you call it cash surplus to start our fiscal year 2022. Within the context of financing our deficit, I think the option domestic and foreign is still very open. As of now, we rely on a domestic market, as also Minister Dominguez mentioned, that the ability to actually issue domestic bonds, especially because the role of the foreign buyer has been declined sharply into only 19%. So we are deepening our bond market domestically, and that's also creating a much more stable. And combined with our external balance, which is strong, that's also creating a domestic local currency denomination bonds, which actually the spread to the US dollar bonds at 10 years is narrowing. It's actually not widening. So the increase of the yield since the crisis in Ukraine is actually quite limited if you compare with many other countries, emerging countries. So we are actually still continue enjoying first, of course, the cash surplus that we are having. And second one, domestic market deepening on the bonds market, especially government bonds market. The third one, we also at the same time still have what we call it the arrangement with central bank. We have 3 years arrangement with central bank, Bank Indonesia, on first that they are playing as a standby buyer on the primary market, and at the same time the direct primary placement, which is related to our spending on both health and social spending. This is providing us with a cushion around 244 trillion. So this combination is actually provide us with the ability to maneuver, especially when the market, global market, foreign market is still in a very unfavorable like today. On the same time, we also still can rely on other alternatives, like for example, the samurai bond mentioned by Minister Dominguez, and also policy loans coming from multilateral development bank. So these are all providing us with choices, but we are very mindful that this kind of situation definitely need to be maintained and managed very carefully, because there is always a limit. But at the same time, today we are enjoying quite choices that is available for the government to choose in terms of financing of our deficit. Last note, of course, because our expected deficit is going to be declined quite significantly, that's also providing us with a much less pressure on the financing side.
And just like that, our 25 minutes are up. Indonesia's Finance Minister, Sri Mulyani Indrawati, and Philippine Finance Secretary, Carlos Dominguez, I thank you so much for your insights today. Thank you for your time.
Thank you for having us.
Thank you.
Last week, we spoke to spiritual economist Dr. Ravi Batra about his belief that the end of capitalism is nigh. By 2016, he reckons, basing his prediction in part on the teachings of Indian guru P.R. Sakar and the law of social cycles. Dr. Batra struck a chord with you. If you did not catch the interview, you can hear it on our website, radionz.co.nz. Click on Saturday morning. Dr. Batra is just one of a seemingly increasing number of people convinced that the 2008 global financial crisis and the current European disaster mean that another financial system is needed soon. Ralph Manji, for example, he was a global financial trader for investment banks for over a decade in London. For part of that time with the same company that Prime Minister John Key was with, actually. Then Ralph Manji had an epiphany. He started something called the Sustento Institute, which is a policy development organisation. He moved to Christchurch 9 years ago. Ralph Manji says debt is the problem and he has a solution, and he's with me now. Hello.
Yeah, good morning, Kim.
This is good news.
Hopefully, if we listen to the message.
Your solution, which you're recommending on a global basis and on a local basis in terms of the renewal of Christchurch, focuses on what you call the debt-based financial system. How would you change it?
Okay, we need to look back in history and think about how money actually comes into existence. I think people today, if you went out onto the street and asked them where does money come from, they would look rather puzzled and they would think about it for a few seconds and think, doesn't the government create it? Doesn't the Reserve Bank create it? And that's not the case. Since 1688, since William III came to the throne in the UK, the right to create money has no longer been a sovereign right. It was essentially privatized. So the banks were allowed to actually create the money supply. The Bank of England was formed in 1694 as a prime reason for doing this. Actually, it was formed to pay off war debts, but primarily it set the tone for how private banking would work over the next 300 years. Now, the problem with that is the process by which money comes into existence. At the moment, the banks create money in the form of interest-bearing debt. Now, that has a real issue because of compound interest. When money comes into circulation as debt with interest attached, that interest is not actually created. So the interest does not actually exist in the current money supply. And it's that driver that actually underpins the whole financial system. So in essence, and people will understand it, everyone is always borrowing money to pay off previous debt, to fund the interest payments. Now, what we're suggesting is that we go back to how money used to be created by the sovereign, and that governments should issue money, debt and interest-free, into the economy. And the example we gave for Christchurch is that obviously we have to rebuild the city. There's a lot of infrastructure rebuild that is going to happen. So rather than borrowing the money, which the government never has to do, the government should actually create that money itself and spend it directly into the economy. Now, as that money flows around the economy, it has no interest attached to it. It becomes part of the physical money supply, and therefore there is no impetus in that system to drive further debt growth, further borrowing, just to pay off that money. I mean, what we're seeing in Europe and the US at the moment is really a mathematical extension of the debt-based monetary system, where the interest burden absolutely it overwhelms the ability for people to repay that debt, and that's when the system collapses. And actually, this has been going on for a long time now. An economist in the UK, Fred Harrison, wrote a book called Boom Bust, 2010, House Prices, Banking and the Depression. And he looked back over 400 years and identified an 18-year cycle. And it's interesting that your economist last week was talking about that. An 18-year cycle, which he tracks all the way back from 1600 of booms and busts.
Yeah, I think that Dr. Batra had a different year cycle, but there are...
Yes, I mean, there's lots of different cycles. I mean, there's long wave cycles and so on.
So I can't quite get my head around. You're saying we've run out of money, our debt's too great, so let's make some more.
No, see, this is I guess the slight confusion is that money really is a construct. It's something that we make up to oil the wheels of commerce. Now, the important thing about money is that there's enough money to make sure that we can meet our needs, that people can exchange goods and services. But what we've done is we've commoditized money. We've made it into a commodity that we buy and sell.
Well, you would know.
Yes, absolutely. And then we've created certainly in the last 20 years, a whole industry based on what we call derivatives, which is basically, mathematical modeling based on money, which creates these ever more complicated instruments that people can invest in for a return.
And everything's leveraged, right?
Everything's leveraged. I mean, that's really the big problem. I mean, what we're saying is, let's stop issuing money as debt. We don't need to. So, for example, the government bond requirement for next year is going to be around $13.5 billion, which the New Zealand Debt Management Office will issue those bonds. That is going to cost the taxpayer between $600 and $700 million a year in interest. It's absolutely unnecessary. The government can actually create that money itself. It does not need to borrow the money. That is really sort of the key issue here. People assume that when they go to the bank to borrow money, that they're borrowing money from somebody else. Well, they're not. The way the banking system works, and people may be familiar with the fractional reserve system, it's simply a bookkeeping entry. When the bank is not lending you somebody's money, they're basically creating a loan, and that loan obviously becomes a deposit at the same time, and that deposit has interest on it, the loan has interest on it, and that's where they make their margin. But there's no need for governments to do that. So if government spending is 30 to 40% of the economy, it's ludicrous that we borrow that money and then pay interest on it. And I think the government debt at the moment is around $70 billion. We're paying $4 billion a year for no reason.
So government debt, however, here is far less than government debt in Europe. And if we compare ourselves with European countries, we say, oh, well, ours is less than 40% of GDP. We're all right. You're saying, no, we're not.
Not really. If we go down the current road, we will end up in a situation like Iceland. We will end up in a situation like Greece. We will end up in a situation like Italy. It's just the way the system goes. I mean, what we're seeing in the US and Europe at the moment, and what we have seen in Japan for the last 20 years, the only reason Japan hasn't collapsed is that they have a huge current account surplus. So people are happy to keep lending them money. And also their interest rates are pretty much at zero. So Japanese government debt is 200% of GDP. But, has there been any problem there? No. But is the economy moving? Not really. So the main problem is the interest. So Italian yields now are over 7%.
What does that mean?
That's their real problem. What it means is they're having to pay 7% on their government debt. And that's just too much. They cannot afford that.
So you want to move from a debt-based financial system, a fractional reserve banking, as you put it, to one of full reserve, and the government would make or order the Reserve Bank to issue money to the Treasury to pay for stuff.
Absolutely. Now, I think the long-term aspect of this in terms of 100% reserves, and there are a couple of movements. There's for example, the positive money movement in the UK and New Zealand, and it's starting to spread around the world, are calling for 100% reserves. Irving Fisher, the US economist, called for this. I'm not saying that we have to go there right now. It potentially could be a very long-term solution. I think what we need to focus on now is the fact that the government itself does not need to borrow money. The government can bring in what I call good money. So if we call the proposal monetary dialysis, we're bringing in good money and we're flushing out the bad money, which is the interest-bearing debt, which is unnecessary.
There's a consumer caveat that's constantly issued with regard to financial deals. If it sounds too good to be true, then it probably is. What's the downside of this? There's got to be a downside.
No, there's no downside. let me take you back. Well, I'll tell you the only.
Why
thing
doesn't it happen then? If there's no downside, why doesn't it just happen?
Because it's about power, it's about influence, it's about embedded interests, and it's about history as well. And I'll take you back to the US, because this is really all about the US and the UK, the War of Independence in the US, and the US becoming an independent nation. I'll take you back to what Benjamin Franklin said in 1764, one of the founding fathers. In the colonies, we issue our own money. It's called colonial scrip. We control its purchasing power, and we have no interest to pay to no one. And really, the first 150 years of the US was a battle between the people and the banks. All the early US presidents, Jefferson, Washington, Jackson, they were all fighting against the banks. They were all fighting to create a solid money supply which could, help the economy to function. Now, I'll give you an example of the banker's perspective, and this is from the Secretary of the American Bankers Association in 1877, where basically this is after Abraham Lincoln had created the greenbacks, which was, government-issued money circulating around the economy. The economy was doing very well. The bankers didn't like it. So this is what the Bankers Association Secretary had to say. To repeal the act creating banknotes or to restore to circulation the government issue of money will be to provide the people with money and will therefore seriously affect our individual profits as bankers and lenders. And that's really what it was all about. And President James Garfield, a few years later, said, whoever controls the volume of money in any country is absolute master of all industry and commerce. And when you realize that the entire system is very easily controlled, one way or another, by a few powerful men at the top, you will not have to be told how periods of inflation and depression originate. And The Economist perspective, this was in 1902, Professor Davis Rich Dewey, said the issue of currency is a function of the government, a sovereign right which ought not to be delegated to corporations. Now, if you want to know why we're in the situation we are, it's because the bankers won. And in 1913, the Federal Reserve was created in the US, and that really was the end of the dispute. And since, for the last 100 years, we have had a debt-based monetary system. We've had the Great Depression. Every 18 years, we've had booms or busts. And I think what we've seen in the last 30 years is the extension, the deregulation of financial markets, and just a phenomenal increase in leverage, so that the system really is totally out of control.
Point of clarification, what was your epiphany? I mean, there you were, presumably happily working in the areas of leverage and debt-based, was it? And suddenly you woke up and decided you were on the side of the devil?
No, not at all. I think, I was a currency trader, like John Key, and it was a fun, enjoyable job. But I think I decided to. There are periods when you're trading, you've got big trades on, and you're not actually really doing very much. So I took myself back to university, and started to get into the whole sustainability movement, and that led me to meet some very interesting people and read some interesting books about the monetary system, how it was constructed, how money came to be created, how the debt-based system actually drove the economy, and also how it drove the economy off a cliff every so often, which is why we have recessions, which is why unemployment goes up, which is why, as I think Ravi said last week, wages are always suppressed. I mean, the Welfare Working Report group here showed that for the bottom 50% of New Zealanders, real wages had not gone up in the last 20 years. That's why people feel poor.
Did the debt-based system work for a while until people carried it through to ridiculous extremes, or did it?
I mean, it can do, because there's two issues here. One is that we need enough liquidity in the economy. Now, at the moment, what we've seen over the last 2 years... But
can't have too much. I mean, to some extent, the debt-based system must, if working really well in moderation, must bring moderation, must it not?
No, see, that's unfortunately where it's broken down. Traditionally, it might have done, because there were very, very strict limits on how much people could borrow. So I don't know if you remember, in the old days it was, 2 or 3 times your income. Now, with deregulation in the 80s, all of that went out of the window. And it became, we got to the point where it's, can you pay the interest? That's all that anyone cared about. So the system became a lot more extreme. And then what we saw in 2005 in the US is that the big 5 investment banks, got together with the with the Secretary Commission and basically said, look, we can regulate ourselves. We don't need leverage limits. And away they went. And we saw what happened with Bear Stearns and Morgan Stanley and Merrill's and so on and so forth.
Were they stupid? Were they stupid or wicked?
They were greedy. They were greedy, and Kim, the whole point is people don't know. I mean, people. This is not a judgment on people. People working in the system don't know. So when I educated myself, and I thought,
really,
this
I mean, you really didn't know how it worked, even though you were right in there. You didn't know how it worked.
Not. No, and I'd studied economics at A level and at university. It's monetary economics is not taught properly at university, and there's a professor of economics at Southampton who's actually saying that academic journals have refused to publish any work in the field of monetary economics, which calls into question the debt-based monetary system. So this is really just, let's be sensible here. We do not need to create money in this way. That is really the reality.
But if you don't have a debt-based system, which, if it's working with some constraints, I take your point, could lead to some moderation, then what's to stop inflation if you're pushing free money into the system?
It's not free money. It's money that doesn't have interest attached to it. Now, I mean, this is
that's free money, isn't it? The interest is the cost.
No, see, this is, if in a way, what you've been conditioned to believe, that money should have a cost. Money doesn't need to have a cost. It has a cost because that's how banks make money. All we need actually is a sufficient pool of money in the economy to make sure that we can carry out all of our economic transactions. So in terms of inflation, that's the other part of the piece. The stability of the money supply is extremely important. What people like to know is that the money they've got in their pocket has some value and that it's stable. And I'll give you some numbers over the last 20 years here in New Zealand. This is from 88 to 08, which is when the financial crisis really hit here. The inflation rate was actually fairly well contained. It rose 65% over that 20-year period. The money supply rose 409%, and at the same time, house prices rose 421%. So the fact is we have actually had severe inflation here in New Zealand, but it hasn't been reflected in the inflation rate because inflation doesn't measure asset prices. So really, we need to keep a lid on asset prices. We need to keep a stable supply of money, but it does not have to be issued as debt. That's really the point here.
So will inflation not occur under your system, under your non-debt-based system?
No, absolutely not. And you could argue that interest actually drives inflation. Actually, I was reading some work on the Reserve Bank website where they actually were surprised to see that high interest rates can often lead to inflation, because what it does is it creates more demand in the economy for extra money to pay the higher interest rates. So you could actually find that bringing money into the economy without interest is actually going to lead to less inflation as long as the supply of that money is controlled. So, the suggestion we made for Christchurch was $5 billion. That's not a big amount of money. We have a big output gap in the economy. There's a lot of unemployed people. The economy is, operating well below maximum capacity. So we're saying, let's do that. Let's show how it works. Let's show that we can do that. We don't need to borrow that money. Let's save ourselves $250 million a year and start to think about this. And actually, what we really want, and we have been, speaking to the Minister of Finance for several years now with various proposals, is we want to sit down with the Reserve Bank, we want to sit down with Treasury and say, okay, let's have a look at our monetary system. Are there better ways of doing it? There are lots of proposals out there. There's lots of community currencies, lots of mutual credit, barter currencies. There's lots of way of stimulating the economy in a non-inflationary manner and actually having a much more stable supply of money. And that's really what we're calling for here.
And what was the Minister of Economics' response to this suggestion?
They tend to generally pat stuff back and say, oh, it's not something we're that interested in. But I think the reality is that they need to start opening up now. They need to start opening up the policy formation framework. They need to realise that there are a lot of people now working outside of government, working outside of the formal channels, who have interesting ideas, who have studied the system a lot. Like, you could call up the Reserve Bank and you could ask somebody on the phone to explain to you how the monetary system works and how banking operates, and you know what? They won't be able to do it, because they get to a point where actually they go, yeah, that sort of doesn't really make sense. So you ask them a question, well, why can't the government create money? And they won't be able to answer it. Now, traditionally, people always said, well, you can't print money because of inflation. But that really is a bit of a red herring. Obviously, you want to control the actual supply of money in the economy. And this goes back to the early days of monetarism and Milton Friedman, who was, a big fan of targeting physical monetary aggregates. But they used interest rates. Now, we believe interest rates don't work properly. I think even a lot of people in the Reserve Bank would agree that inflation targeting doesn't particularly work very well. The demand for money is driven by other things, it's specifically whether banks actually want to lend money. And so we believe there are other options.
What's quantitative easing? Is that not what we're talking about?
No, see, this is another problem. This is where the power issue comes. If you think about those quotes from US history and the issue of power interests, what happened in the US, and obviously the Japanese started it, is governments thought, okay, well, we need to generate liquidity in the banking system. So what they did is they monetized the debt of the banks. So they basically put liquidity into the banks' balance sheets. But then the banks didn't lend. I mean, if we look how much money is being pumped into the US, I don't know, it's something like $4 trillion now. Where's that money? It's disappeared into the...
Because it was given to the banks.
Because it was given to the banks.
Whereas you're saying that if it's injected more directly into the economy...
Yes.
Given to who, though? Where?
You just put it into infrastructure projects, but actually you could. Economists like Rubini have actually come round to this point of view, and recently he said what the government should have done is actually directly spent the money into the economy, because what people are missing is liquidity. There is no money in the economy. Like you go in New Zealand, you try and get a tradesman now, they want to be paid immediately before they even do the job because there is no cash circulating in the economy. Now, what the Americans should have done is injected money directly into the economy through public expenditure. So infrastructure projects, build new schools, build new hospitals, stuff that actually makes sense, not what they've done in Japan, which is build airports that no one goes to.
So essentially,
to nowhere.
what you are recommending is an increase in the role of the state. A massive increase in the role of the state. Surely.
Actually, not at all. Because if you think about it, government expenditure is already 30 or 35%. What we're talking about is the way that we finance that. That is really. We're going to rebuild Christchurch, whatever. It's how we finance that is the issue. But we should stop giving money to the banks. So that's what quantitative easing is basically giving money to improve banks' balance sheets, hoping that banks will do the right thing and go and lend out that money. Well, that's completely ridiculous. We can actually just directly spend it into the economy. The economic activity happens. The interest bill is lower, and therefore that actually has a disinflationary effect. So because people are not trying to get that extra money to pay the interest.
There are other legs to your plan. Participatory universal income is one of them, or as some people have called it, guaranteed minimum income. This is an idea that comes and goes. It's just one single payment to everybody, and a flat income tax, no superannuation.
Yeah, I think this is slightly different, but the two things are connected.
I was going to ask you, do you have to have that in order for the rest of it to work?
No, not at all. This
right.
is a kind of a welfare reform system. Now, Gareth Morgan's come out with his proposal, the Big Kahuna, which is a guaranteed minimum income. Where I see us moving to is that in the next 20 to 30 years, the whole jobs market is going to change. Governments are carrying on as if the world is going to remain exactly the same and that there's going to be more and more jobs, etc. We may actually move to a point where technology starts to drive the amount of jobs down. And we will have to face the fact that, to create a decent society, we'll have to recognize that, we may have to change the way that we organize things. But I think the whole welfare system, which really, is a kind of humiliating process regarding people, that don't work as not contributing to society, whereas many of them do. They raise children, which is probably the most important job in society. They look after people who are sick. They do voluntary work in the community. They are making a contribution. And, I work as a budget service advisor, and I've yet to meet a client even who's, in terrible debts, who doesn't want to pay it back, who doesn't want to get a job. So I think a more efficient way of doing that is actually to just say to everyone, okay, we will give everybody a basic living income so that they can live on that. And we will give that to everybody. We will eliminate welfare completely. There'll be no more wins. There'll be no more means testing. There'll be no more need for superannuation because you'll get it for the whole of your life. We'll reform the tax system so that we start to remove taxes from income and we put taxes on resources. So, for example, land tax. And again, the Reserve Bank and Treasury have done plenty of work on this. And there's lots of people there who actually support that. Creates a much more efficient system. It's a much more dignified system in terms of it values all the different types of contributions that people make within society.
What if they don't
community.
contribute? I mean, what if they just, sit in their bedroom and eat instant noodles?
Yeah, well, I think it was the
Sounds
famous,
tempting, doesn't it? I know.
Well, I think it was the US philosopher John Rawls coined the term Malibu surfers, and maybe we'd have, I don't know where people surf in New Zealand, but we might have the same thing here. That's really, again, it's another one of these red herrings that you get a little bit like sort of, oh, what about inflation? The reality is not true. What I quite like about a participatory income, now some people think it should be universal regardless, is that we want people to participate in society. So it doesn't matter what you do. You may have, a lot of people will still be working because they want to have, a sort of a more expensive lifestyle. People might be raising children. People might be doing voluntary work, community work. People might be doing coaching or mentoring in the community.
Well, they might be, but
yes.
There are people who won't be. Do you just sort of ignore them?
I think that's why you can make it a participatory income. So there's an element of coercion, but I think it's actually trying to get our society back on its feet. I think unemployment has what it does to people and the kind of the vindictive nature that it is applied to beneficiaries. It's unhelpful. It creates dysfunction in our society, and I think we can do things a lot smarter. And the fact is, this is not a new proposal. It has been around for a long time, but I think the time has come in terms of the way the financial system is imploding, that we need to sit back and actually look more closely at where society is going, the makeup of society, what jobs are going to look like in the future, and realise that there's lots of different types of contributions that people can make.
What do your former colleagues say about your ideas?
I think some of them actually appreciate them. But the reality is, Kim, I mean, people have to earn a living, and I have friends who still work in the markets, and they're great people, and they're just sort of doing little jobs, within the bigger system. So, I'm not being judgmental about what anyone does. What we have identified, and what has been identified for a long time, is that there is a real problem with the way the system is structured. That is the key thing. So I think people, friends of mine appreciate the work that I'm trying to do, and that they think, Raf's got another idea. So I think a lot of people agree with what's going on.
What do you think is going to happen in Europe, as briefly as we can deal with this calamitous situation? I mean, many commentators, I was reading Brian Gaynor, who says, eventually New Zealand's going to go down the same track as the pigs, so to speak, and now France.
Well, that's what we can avoid that completely. If we follow this proposal, we can avoid that completely. In terms of what's going to happen in Europe, they have two choices. They either have full fiscal integration, or people start to leave. It's as simple as that. There is no way in the middle. The fudging that goes on, and the reality is, Kim, that the leaders in charge, they don't really understand the system. They don't understand what underpins it, and therefore they try to create solutions from, if you like, the current toolbox, and the current toolbox just doesn't work. So either everybody gives up their fiscal sovereignty, which is basically their ability to tax, and they allow the ECB to take that over. That is a possibility. And if you're a real Europhile, you could say, look, guys, let's, we went halfway with monetary union, let's just go the whole hog and create the United States of Europe. If people don't want to do that, and there may be some issues around that, then Greece has to leave the euro. The problem is there is no ability for countries to lower their exchange rates to rebalance their economies. And that's a problem that we have here in New Zealand, is that the exchange rate's been ignored for years, and we've allowed the carry trade to completely, destroy our current account deficit.
It's all right. Well, if we took back our financial sovereignty by moving from the debt-based financial system effectively and issuing new money, how would that affect the free trade, the globalization, our dealings with the rest of the world?
It won't affect it at all, because what I'm saying right now is let's focus on the government debt, okay? Let's leave the private debt to one side for the moment. Right. So I'm saying, hey, let's dip our toe in the water and let's see what happens.
And government debt, gross crown debt,
yes,
is what, like 76 billion now.
Yes, I don't know what the gross number is. The net number is 71 billion at the moment.
All
So
right.
we're paying $4 billion a year. It's ridiculous, $4 billion a year, and we've been paying it forever. It's a waste of money, and New Zealanders are suffering because of that.
I'm not asking for a rallying cry from you, but do you sense more now than before, and you've obviously got a sense of history, that there is a call for a change that will not be resisted?
I think so. I think what we're seeing with the Occupy movement, which clearly they haven't articulated this type of thing.
No,
I
but
think that
Dr. Batra has articulated it for them, I think.
Yeah, no, I mean, and I think that's right. Yes, often in life everything's about timing. Like I made a very similar proposal at the House of Lords in the UK 10 years ago, and it became an early day motion in Parliament, and it just never really went anywhere. But it's all about timing, and so the system is falling over, and I think more and more people are starting to realise that we need to do something. People are doing things at the community level, like time banking. We've got here in New Zealand community currencies. We have some, new candidates coming forward in the elections. There's a couple of independent candidates standing in Wellington for the new Economics Party, which is.
Let's not electioneer.
No. What I'm saying is that there is a shift. There is a shift in people's thinking that they are more prepared to think, okay, is there an alternative solution? But there is one problem that I should mention,
Yes.
and the problem comes from agreements like the Trans-Pacific Partnership Agreement, which
Yes.
are being negotiated in secrecy, which may restrict our ability to even do things like issue our own money. So we have to be very, very careful that we do not negotiate our sovereignty away. It already has, to a large extent, been negotiated away, but we can reclaim our sovereignty, and we can put our country back on its feet, and we can make it a prosperous country for all people.
Europe. But I put it to you, we're a small open economy. We have high levels of private sector debt. Mum and Dad have borrowed that debt effectively from foreigners because their local bankers sourced that from foreigners.
Yeah, well, again, I mean, that's very dangerous territory for a country that's capital strapped, that has massive net external liabilities. I mean, no OECD country borrows more of its borrowing from foreigners than New Zealand. So if you put a tax on that, you have to get into the definition of what is hot money, what is legitimate investment in New Zealand. You run the risk that you ultimately force up interest rates, and that's a more expensive burden on the economy. So, I don't think that's practically going to work.
But while that inner guts of the system, the web of contracts, is important, the even more important driver of financial instability is simply rising leverage of a particular form, and a particular form on which finance theory and macroeconomics has been entirely silent, or mainly silent, or to the extent that not silent, it has been wrong. If you pick up most undergraduate textbooks, and we were talking earlier this morning about the role of what we have to do in teaching undergraduates and graduate economics, and you see how they describe the role of the banking system, they make two mistakes. First of all, they describe a system which takes money from savers and lends it to borrowers, failing to realize that the banking system creates credit, money, and purchasing power ab initio, de novo, and with an important role, therefore, within the economy. But also, again and again, it says, well, what banks do is they take deposits from households and they lend money to businesses, making, as Joe referred to earlier, the capital allocation process between alternative capital investments. As a description of what modern advanced economy banking systems does, this is completely mythological. This is very well described in a forthcoming paper from Alan Taylor and Maurice Schullerich, reflecting some INET-sponsored research. Basically, in advanced economies, 85% of our bank credit is not to do with funding capital investment. It is funding two things. It is funding either consumption, that may be valuable, but we need to understand why that is, why funding a consumer credit would be valuable and to what extent, and the vast majority of it funds real estate. Sometimes either residential or commercial. Sometimes that is funding new real estate investment, which is a form of investment in the economy, but most of it is funding the purchase of already existing real estate. And it is fundamentally funding in a credit form a competition between ourselves for the ownership of locationally specific urban land. And that, I think, is absolutely fundamental to the instability cycle. Because it is that competition for the ownership of existing real estate and of locationally specific land which is in relatively fixed supply that creates instability. Because if you put together the fact that the banking system that can create infinite quantities of credit and money and purchasing power, and that urban land which is locationally desirable is in fixed supply, whenever in economics you put together something which is infinite and something which is fixed, you get an inherently undeterminate price. We have at the core of our financial system something which is bound to create inequality, bound to create credit and asset price cycles and booms, bound then to create crises and debt overhang and the balance sheet recessions about which Richard Koo has talked so importantly. That really poses a fundamental challenge because it means that we have a free market system which, left to itself, will create a problem not just of a deadweight cost of too much activity in intra-financial activity that we don't need, but will also create too much of the wrong sort of debt. But with the irony that each one of that debt seen as its own looks perfectly socially useful. How could you deny that somebody borrowing for a mortgage is socially useful, but the collective impact of it is something which is incredibly difficult for us to manage and a fundamental problem at the interface between finance and macroeconomics? But to pick up your general point, Paul, I mean, you're quite right. I have posed this question of why is growth so credit intensive, and why does it appear to need to be so credit intensive? And to set out a sort of stylized fact, for the last 20, 30 years, rich developed economies have grown with nominal GDP growth rates of about 5%, but they've had nominal credit growth of about 10 or 15%, which necessarily means that the leverage ratio relentlessly rises, and I think eventually produces a point of a Minsky moment, a crisis, and a post-crisis overhang. And that does pose a fundamental question for us, which is, did we need that credit growth to achieve that nominal GDP growth, i.e. a rate of growth of inflation of about 2.5%, and real growth? If it is, if we really needed that credit growth to have the nominal GDP growth, then, as Minsky once said, we do not have an equilibrium in a monetary economy with capitalist financial institutions as against in a Arrow de Breur, Valrasian, seed and corn barter economy. I believe that there are things that we can do to have a less credit-intensive model of growth, but they require things that go way beyond the remit of central banks and financial regulators. They have to do with both the role of real estate within our economy, but also, crucially, the role of inequality, because I think one of the things that is driving the increase in the credit intensity of growth is an inequality effect. If I can then link that to Ed's point, there was something Ed said which I completely and utterly agreed with, and totally agreed with, and I think he put it beautifully, which is, in this area of, if we believe that we can have credit cycles which are out of control and we want to constrain them, we cannot possibly ask the guys who are selling mortgages to take responsibility for it. As you put it, you can't expect them to go into huddle and say, oh my God, you know, Mrs. X wants this mortgage, seems to be right for her individually, but wow, you know, there's this sort of, you know, a fallacy of composition going on here, I've got to think this through. You've got to have that at the level of public policy, and we have got to constrain the credit cycle in public policy. You cannot do that, and that picks up what Axel says, through the inflation target. The inflation target, unlike what Wicksell sought that provided we hit low inflation by having the nominal interest rate in line with the natural rate of interest, all would be well. I think what we've learned is inflation targeting is not sufficient. We need to pay attention to quantity aggregates, but we need to pay attention to them for a quite different reason from what we thought back in the 1970s and 80s. There was a time when we thought that we'd got to pay attention to quantity aggregates on the liability side of the bank balance sheet, which is money, because it was a powerful forward indicator of inflation. In fact, we pretty soon realized that money is not a good forward indicator of inflation, but instead the credit aggregate, I mean, it's just the other side of the balance sheet, is a good forward indicator of future crisis and post-crisis recession. But what this does mean is I think we do have to, alongside addressing some of the fundamental drivers of the credit intensity of growth, like inequality, we have to have an approach to central banking and macro-prudential regulation, which is paying attention to the overall leverage and rate of growth of leverage and where it resides in the economy. And as Joe said, by constraining it by some policies which some of the developing world have been using, like loan-to-value ratio on limits, which pretty much for the last 30 years, people from the IMF and the World Bank have been turning up and saying, no, you don't want these. These are terribly old-fashioned. They get in the way of the free market allocation of capital. Now, one of the good things that's happened in Canada is that it's actually one of the few advanced economies which also had loan-to-value limits through the conditions for the insurability of mortgages, and you do use those tools. So I think we do have to accept that there is something called the credit cycle, which we have to manage, and we have to focus not on just the objective inflation, nor on just the instrument of the interest rate. Both in terms of objectives and tools, we need a far wider focus.